You've seen them everywhere, right? Prop trading firms promising you the keys to the kingdom, a shot at trading millions of dollars you don't actually have. But is it for real? Or is it just a slick new way to sell an old, impossible dream? Well, to figure that out, we're going to dive deep into one trader's absolutely incredible and, yeah, controversial journey to managing over 5 million bucks. Talk to any veteran trader, and you'll find a ton of skepticism about the strategies you see plastered all over YouTube, especially something called smart money concepts, or ICT. The general feeling is, come on, it's all just marketing. I mean, if these concepts were really the secret code to the markets, wouldn't we be tripping over millionaires on every street corner? It's a pretty fair question, right? And then there's Kyle, a trader who uses those exact ICT concepts and is, verifiably, managing over $5 million in funded capital. He's already taken home nearly $1 million in payouts. This just doesn't line up with the skepticism. It's a direct contradiction. So, what's going on here? How is that even possible? Okay, here's how we're going to break it all down. We're going to look at the long, hard 8-year grind he went through before seeing any success. We'll see how he climbed the prop firm ladder, take a peek inside his actual ICT strategy, and then get into the mindset stuff that really, truly made the difference. And at the end, we'll try to answer that big question. Is this a blueprint, or is it just a gamble? All right, first up, let's talk about the part of the story that most trading influencers just conveniently leave out: the grind. Kyle's success was not an overnight thing, not even close. It was built over almost a decade of failing, learning, and just refusing to quit. So get this, he starts back in 2011 totally broke. He then spends the next 6 years working a really demanding construction job, trying to trade on the side. But here's the number that just blows my mind. It took him eight full years of being unprofitable before he could finally go full-time. Most people would have thrown in the towel after year 1 or 2. 8 years? That's some serious dedication. And this, right here, this is what separates the serious professionals from the gamblers. Before he took that leap to full-time trading, Kyle didn't just cross his fingers and hope for the best. No way. He saved up a 2-year safety net, a full 2 years of living expenses in the bank. This wasn't some reckless jump, it was a calculated business decision. It gave him the mental space to trade without being desperate for every single dollar. So the big question is, how do you go from a small personal account to suddenly managing millions? For him, the answer was proprietary firms. They offered this really unique path to get your hands on huge amounts of capital, even if you're not already rich. And you can see why it's so tempting. Instead of grinding for years to build up your own capital, a prop firm lets you trade a massive account for a pretty small entry fee. But, and this is a big but, the pressure completely changes. It's no longer the fear of losing your own life savings. It's the intense psychological stress of managing drawdowns on an account that might be bigger than everything you own. So, what's the actual strategy that made all this happen? Well, Kyle gives all the credit to those controversial ICT concepts. But for him, it's not about some magic formula. It's about finding a pattern that repeats itself and then having the discipline to execute on it over and over again. Now, a huge piece of his strategy is identifying something called a fair value gap, or an FVG. So what the heck is that? Well, to put it simply, it's a spot on the chart where price shot up or down so fast that it left behind a kind of inefficiency, a gap. And the whole theory is that the market often wants to come back and revisit that gap to fill the orders that got left behind. That makes it a really high probability spot to look for a trade. But here's the crucial part. Kyle doesn't just trade every single gap he sees. He has a checklist. He waits for a few things to line up. First, is the price at a key premium or discount level? Second, is there a nice, clean, fair value gap? And third, has the market structure actually shifted, signaling a potential change in direction? This little framework is what turns looking at a messy chart into a systematic, rules-based process. Okay, this might be the most important slide of the whole explainer. Let's talk reality. Beginners are always chasing this fantasy of an 80 or 90% win rate. Kyle's reality? About 50%. 50-50. Some months he's on fire, others are a slump. Being a pro isn't about being right all the time. It's about managing your risk so that when you are right, your wins are bigger than your losses. That's the whole game. And that brings us to what might be the real secret sauce here. The true definition of smart money has absolutely nothing to do with patterns on a chart. It's all about how you handle your money and your life outside of trading. And you can hear it straight from Kyle himself. He says being smart money is about financial discipline. How do you handle your personal bank account? Do you even know what your daily expenses are? The thinking is, if you can't manage your own finances when things are calm, you have zero chance of managing a trading account when the pressure is on. You're just going to make bad, emotional decisions. Veteran trader Raja Banks actually has this perfect blueprint for this mindset. Step 1, unfollow all those influencers flashing Lambos and yachts. That is not reality. Step 2, know your monthly expenses down to the penny. Step 3, build that financial safety net so you're not trading from a place of desperation. And finally, when you do get a big payout, don't let that quick money start dancing in your pockets, begging you to spend it. And Kyle absolutely lives this. He estimates that he saves or reinvests around 75% of every single payout he gets. 75%. Another chunk goes to business expenses like networking, and only a tiny slice, 10%, covers his actual living costs. He lives a simple life because he knows that building real, long-term wealth is way more important than looking rich in the short term. So, we've seen the 8-year struggle, the strategy, the disciplined mindset. What's the final verdict here? Is Kyle's story a genuine, repeatable blueprint that others can follow? Or was he just one of the lucky ones who survived a really high-stakes game? I think the big takeaway is that his success wasn't about one magic indicator or some lucky trade. It was built on a foundation of character. The patience to stick it out through 8 years of failure. The discipline to save for 2 years before going full-time. The focus to master one strategy inside and out. And the financial wisdom, the frugality to prioritize wealth over flashy spending. And that leaves us with this final question. For a trader who has all those pillars in place, the discipline, the patience, the strategy, prop firms can clearly be an incredible tool to leverage skill into serious capital. But for the huge majority who don't have that foundation, are these firms just selling an expensive lottery ticket? It seems like the answer has very little to do with the prop firm and everything to do with the trader.